Welcome back. Now, today we are going to drill down in this video and continue on with the Ripple Crypto Trends Report for 2023. We finished part 1 on page 12 and we're going to pick it up from there. So if you haven't listened to part 1, I urge you to go back and start from the beginning and listen to the last video that I did. So on to part 2. This section is called NFTs for Business. Despite the 2022 downfall and what many assume to be a temporary fad, NFTs are still totaling close to $500 million in monthly sales volume. In Q1 2023 alone, the NFT market experienced a 137% increase in trading volume and had a total of 19.4 million NFT sales. Not only is there ample market opportunity, but also endless business opportunity for companies to take advantage of these tokenized assets. This is true across a variety of use cases, from media and entertainment to carbon markets, real estate, gaming, loyalty and rewards, and beyond. In fact, some of the world's best-known brands are using NFTs as their entry point into Web3, including the likes of Tiffany & Company, Nike, and Budweiser. Starbucks is also joining the Web3 movement through the launch of their new NFT loyalty program as a way to promote the brand, improve customer engagement and experience. By offering members the ability to buy digital collective stamps that are minted as NFTs on a blockchain, consumers are granted access to new immersive experiences and online communities, and in turn, increased loyalty and dedication to the brand. Not only is Starbucks able to leverage the technology to engage with their customers in new, meaningful, innovative ways, but customers are also able to better connect with each other and be a part of the community of other brand loyalists. Another area of business innovation using NFTs is related to the tokenization of real estate, i.e. mortgages. In February 2022, a home in Tampa, Florida was recorded as the first in the U.S. to be sold as an NFT on a blockchain facilitated by the Web3 property technology company Propy. Companies like Propy are leveraging the power of blockchain for easier, faster, and more secure real estate transactions, resulting in powerful advantages for both businesses and consumers. By solving real-world problems in the real estate industry around process efficiency and transparency of ownership confirmation, interested buyers can quickly and easily view prior owners, tax records, pricing history, etc. on an immutable ledger. And real estate agencies and property management companies are able to generate more demand for the listed home. In the case of the house in Florida, for example, which sold for approximately 210 Ethereum, the online auction for the NFT drew nearly 3,000 bidders. While use cases like these are driving real-world utility and real business value, we wanted to explore whether or not finance leaders at financial institutions and enterprises understand the value that tokenization can bring to businesses. If so, what are the use cases they see as being the most important and impactful for their business? And if not, why? And why does the industry need to do more to remove those hurdles? So also they have a page here that has a little article inset in this. So I'm going to read that little couple paragraphs here. It says, Crypto conceptualized fractional ownership of real estate with NFTs. Homebase, a crypto startup, tokenized a single-family rental property in McAllen, Texas on the Solana blockchain, and real estate investors purchased the NFT for $246,800. The home was tokenized on Solana via a smart contract tied to an NFT. Because Solana supports the stablecoin USD coin, USDC, this enabled fractionalized ownership of the property among various real estate investors, where users could quickly and easily purchase a portion of the property's value in a single click. Fractional ownership of real estate via NFTs is driving greater financial inclusion by making property ownership and equity stakes more affordable and accessible for more people. Real estate tokenization projects are bringing more players into the market, more assets on chain, including Solana, XRP Ledger, Ethereum, and others, to increase liquidity and simplifying the home buying, selling, and renting process with secure, verifiable transactions, automated processes, and fewer intermediaries. Okay, so that was the little inset there. Okay, so now we're into a section called Use Cases and Impact. As mentioned above, we see the tokenization of real-world assets, or RWAs, as one of the most important enduring use cases for tokenization. It appears that finance leaders at both financial institutions and enterprises hold similar sentiment, the former slightly more so. When asked about the biggest areas of impact of tokenization over the next 3 years, we learned that decision makers anticipate the most massive impact on public stock trading and private share trading, particularly those with cryptocurrency experience in MENA. That's Middle East, North Africa. Across the board, expectations are high for tokenized RWAs, real-world assets, with securitized assets, commodities, real estate, public bonds, private debt, derivatives markets, and carbon markets, following closely behind 1 or 2 percentage points. Among the enterprise audience, the metaverse and ticketing are the top use cases for utility-based NFTs. The business use of NFTs across both instances is primarily around secure, tamper-proof, transparent records of ownership and a means of bridging physical and digital experiences and transactions. Indeed, the experienced amount of NFT-related metaverse transactions is estimated to increase from 24 million in 2022 to 40 million by 2027. Then we have a little box with a graph here, perceived enterprise use cases for functional NFTs over the next 3 years. For metaverse, 67%. For access to events and experiences like ticketing, 51%. Loyalty rewards programs, 47%. Gaming, 46%. IP access rights, 40%. And 3% say, I don't think functional NFTs will have any impact. Going on here, generally speaking, our study found that financial institutions appear to be more interested in tokenization for their business compared to the enterprise audience. 83% said they were extremely or very interested, with 11% currently exploring or using tokenization in their business, versus 66% and 8% for the enterprise audience, respectively. Benefits. Perhaps unsurprisingly, given other findings around the importance of privacy and security considerations for digital assets, over 60% of financial institutions and commercial audiences think that online identity and data protection tools, e.g. antivirus software or SIM cards, would benefit the most from tokenization, followed by stocks at 50%. And only 2% of respondents stated that their business wouldn't benefit from the tokenization of any asset. So it's clear that financial leaders around the world realize the benefits that tokenization has to offer. In fact, in its most recent report, CITI, as in Citibank, predicts the tokenization of financial and real-world assets as blockchain's killer use case, with an estimated growth factor of 80 times in private markets and $4 trillion of value by 2030. Okay, I'm going to read that one again because I had not remembered this statistic. Leaders around the world realize the benefits that tokenization has to offer. In fact, in its most recent report, Citi predicts the tokenization of financial and real-world assets as blockchain's killer use case, with an estimated growth factor of 80x, 80 times, in private markets and $4 trillion of value by 2030. Okay, that's good. Where the data from our study gets really interesting is how these tokenized assets would benefit the business. While the cited benefits of each tokenized asset shift and vary slightly, there are consistencies among the top 4 benefits and the bottom 3 across the board. In other words, regardless of which asset is tokenized, Respondents expect access 24/7, 365 markets, greater financial agility and flexibility, enhanced security and privacy, and improved efficiency and automation. We wanted to find out firsthand what benefits, if any, global finance leaders at both financial institutions and enterprises think NFTs specifically can bring to their business. Almost half, 47%, foresee the benefit of new revenue opportunities, followed closely by the ability to better manage their data, i.e., improved visibility, traceability, and control, at 45%. When we compare these results to those for tokenization more broadly, we actually see that global finance leaders rank NFTs slightly higher, where tokenization in general is seen as providing better operational efficiencies. That's very interesting. Okay, so now we are on to the most massive impact: public stock trading and private share trading. When asked about the biggest areas of impact of tokenization over the next 3 years, we learned that finance decision makers anticipate the most massive impact on public stock trading and private share trading, particularly those with cryptocurrency experience in MENA. Barriers to adoption. As with any nascent technology, there are barriers to more widespread institutional adoption. While we did learn that the majority of respondents are likely to explore tokenization in the next 3 years, we also learned that many of those same respondents, those at enterprises and in roles related to digital transformation, blockchain/cryptocurrency, and innovation at financial institutions in particular, have concerns around security and lack of regulation. This isn't surprising, given the roller coaster ride that tokenized assets have been on for the past year. The lack of clear regulation in the US and other jurisdictions around digital assets and cryptocurrency only further fragments an already complicated patchwork landscape that companies are expected to navigate. CBDCs and stablecoins. According to McKinsey, roughly 90% of the world's central banks are now pursuing CBDC projects, up from 80% last year. Additionally, Juniper Research forecasts the value of payments via CBDCs to reach $213 billion annually by 2030, up from just $100 million in 2023, representing a massive 260,000% growth rate. Analysts attribute this growth to declining cash usage, increasing demand for privately issued digital assets, central banks' desires to not get left behind in the race to innovation, and the rise in local governance amidst a global payments landscape. So I'm going to pause there and just say, I did a whole video about that 260,000% statistic. So if I didn't stop and get all excited about it right here, it's because I've already talked about it, tweeted about it, and mentioned it quite a lot. So if you haven't listened to other videos about that and you want to hear more about it, go and look at some of my older videos, and I go into depth about the 260,000% growth rate of CBDCs. All right, we go on. With widespread access and distribution capabilities, the promise of CBDCs to promote financial inclusion, enable fiscal and monetary policy, and economic growth has central bankers around the world piloting use cases. Over 120 countries, large and small, are now exploring CBDCs at varying stages of development. This represents over half the world's countries and more than 95% of total GDP. China is the furthest along with their digital yuan, or eCNY, and other exploratory projects like a digital euro, digital pound, digital rupee, and digital dollar, among many others, also ongoing. Citi estimates as much as $5 trillion worth of CBDCs in various currencies circulating throughout major economies over the next decade. Where CBDCs are digital currencies issued and managed by the government, stablecoins in many cases are issued and managed by private entities rather than created, controlled, or regulated by a country's central bank. Because stablecoins are pegged to a major currency, for example the US dollar, they usually have little to no volatility, hence the name, beyond the volatility of the currency they are pegged to. This also means stablecoins demand remains high even during market fluctuations. Stablecoin adoption has been on the rise over the past few years. In 2021, 13% of crypto payments made on BitPay, a Bitcoin payment service provider, used stablecoins like Tether. And total circulating stablecoin supply grew from $29.38 billion in January 2021 to over $182.14 billion by March 31st, 2022. The Block Research's 2023 Digital Asset Outlook report points to stablecoins finding product market fit and institutional adoption, with overall usage setting new records in 2022. Annual stablecoin adjusted transaction volume, i.e. a payment flow from one address to another on a public blockchain, crossed $7.2 trillion in 2022, 19% year-over-year volume growth. That's $7.2 trillion for annual stablecoin adjusted transaction volume in 2022. In fact, fiat-based stablecoins are considered one of the most successful tokenization use cases outside of cryptocurrencies, since they typically serve as base assets for most trading pairs on centralized exchanges. Stablecoins pegged to USD have seen the most traction to date. According to the Block, the largest group of non-USD stablecoins is euro-pegged, with a market cap of 581 million euro, which is $605 million US. That's in comparison to a $145 billion total market cap of all fiat-backed stablecoins. That being said, stablecoins pegged to other fiat currencies will continue to gain adoption in the coming years as regulatory frameworks continue to materialize, particularly in Europe, Latin America, and Asia. It's clear that CBDCs and stablecoins are finding their foothold in the industry, but what's driving that innovation? And how are central bankers and other finance leaders preparing for a digital currency future? In our study, we explored the current state of adoption and the level of understanding around CBDCs and stablecoins, the biggest perceived benefits and largest barriers to adoption, perceived impact, and adoption plans. Global finance decision makers predict CBDCs and stablecoins will have a massive impact across business, finance, and society. This sentiment is particularly strong among those with cryptocurrency experience and those based in LATAM and MENA regions, Latin America and Middle East, North Africa. While impact ranked high across the board, those in compliance and treasury roles were a bit more conservative in their estimates. Comparing these results to last year's survey, we see that not only do more respondents expect significant or massive impact of digital currency on business, finance, and society, but they expect this to happen within a shorter period of time. In other words, impact from these digital currency technologies is and will continue to accelerate at a faster clip. Then they have a chart here, perceived impacts over the next 3 years. And they show CBDCs predicted to have significant impact, 50%, and stablecoins 49%, impact on finance, central bank digital currencies 46% significant, answered significant, and stablecoins 45% said significant impact on finance. And then when asked about impact on society, 53% said CBDCs would have significant impact and 52% said stablecoins would. So people are predicting big things for CBDCs. Specifically, respondents appear particularly bullish on the overall impact of digital currencies on payments. Nearly half, 46% of all respondents, think stablecoins will have the largest impact on cross-border payments and anticipate the largest impact of CBDCs to be on consumer-to-business payments, 39% of financial institutions, and cross-border payments, 41% of enterprises. Many are either somewhat or very likely to begin using cryptocurrencies, CBDCs, or stablecoins in their business in the next 3 years, and are confident that the technologies can meet their business needs. Again, we see respondents in LATAM and MENA ranking slightly higher than those in other regions, and particularly those decision makers at financial institutions who work in roles related to digital transformation, blockchain/cryptocurrency, and innovation. Despite all of the issues that digital currencies have faced over the past year, and the fact that it's still a relatively new technology, respondents are still roughly as confident in CBDCs or stablecoins to meet their business needs as they are in traditional and trusted fiat currencies. In fact, in the case of popular cryptocurrencies like Bitcoin, Ether, XRP, etc., respondents are actually more confident in their ability to meet business needs compared to traditional fiat, paper and coins, currency. This is likely due to the fact that well-known cryptocurrencies like Bitcoin, ETH, and XRP are already in widespread use, whereas CBDCs and stablecoins are much newer applications of digital currency technology and still largely being piloted. And it says global finance leaders are more confident in cryptocurrencies to meet their business needs compared to traditional fiat currencies. And then it has a chart here that reflects that. Given the likelihood of near-term adoption, we were curious what the key attributes or determining factors would be for organizations to implement a CBDC, stablecoin, or cryptocurrency solution in their business. Finance decision makers are especially interested in these technologies for their inherent security and stability. They are more apt to choose CBDCs for AML, KYC, and stablecoins and cryptocurrencies for their perceived ease of use. Since CBDCs are controlled and issued by the government, they must meet the high security standards and compliance requirements of the issuing central bank. And stablecoins and cryptocurrencies are much more widely used today, and therefore likely perceived as more familiar and user-friendly. Other important attributes include widespread use by business and customers, liquidity, privacy, particularly for stablecoins, and sustainability. Use cases. Beyond just a digital form of a national currency, CBDCs can support a variety of use cases thanks to their underlying blockchain technology, programming capabilities, and ability to reach anyone with a mobile phone and digital wallet, including the unbanked. Use cases span cross-border payments to micropayments. Think reading a paywalled article or watching a single video without ads. To peer-to-peer lending and government-issued relief spending. And because they represent digital forms of national, i.e. fiat currency, we believe they are poised to have an extremely powerful impact on economies the world over, particularly those countries where the current payments infrastructure is ripe for innovation. Indeed, our study confirms similar findings, with cross-border payments and consumer-to-business payments being the top two most cited use cases for both CBDCs and stablecoins. And then they have a box here that says payments use cases for CBDCs and stablecoins. Cross-border payments, 37%, for CBDCs, 46% for stablecoins. Consumer to business payments, 35% CBDCs, 44% stablecoins. Wholesale, 34% for CBDCs, not NA for stablecoins. Treasury management, 30% CBDCs, 35% for stablecoins. Retail, 30% for CBDCs, NA for stablecoins. Consumer peer-to-peer payments, 29% CBDCs, 40% for stablecoins. Cross-border remittances, 29% CBDCs, 38% stablecoins. Government-to-citizen payments, 28% CBDCs, 30% stablecoins. Vendor/supplier payments, 27% CBDCs, and 39% stablecoins. Okay, on we go. One current example of this is the partnership between the Federal Reserve Bank of New York and Monetary Authority of Singapore to explore how a wholesale CBDC could improve the speed and efficiency of cross-border payments involving multiple currencies. While there is clear demand and enthusiasm around CBDCs for cross-border payments, Juniper Research anticipates domestic payments challenges will be the first to be addressed by the initial CBDC pilots, and their issuing central banks, with an estimated 92% of total CBDC transaction value paid domestically by 2030. Once those systems have been established locally, then the wider payments ecosystem and cross-border payments networks will benefit, but not without foresight and proper planning. As the Bank of International Settlements points out, even though there are various models in which CBDCs can be designed for domestic and cross-border payments, a certain level of interoperability will be required among systems, ecosystem participants, and governance in order for any single solution to scale. Governments should take into account these considerations when designing a CBDC to ensure the necessary infrastructure, and that their CBDC is fit for purpose to support cross-border transactions. When exploring such digital currency respondents would use when exploring which digital currency respondents would use for different payments related use cases, CBDCs ranked highest across the board compared to stablecoins or cryptocurrencies like Bitcoin, ETH, XRP, Binance Coin, Litecoin, Cardano, Lumens. This makes sense given the trusted nature of institutional banking partners with legally backed reserves, insurance protections, and established relationships. So, of course, respondents would be more apt to leverage currencies backed by their country's central bank. Okay, so there was a whole page of charts here for payments use cases where finance leaders plan to use crypto. And they basically have already said all these things, but now they're showing it in just a bar chart format. So we've already really covered that. However, we were surprised to see that respondents are more likely to use cryptocurrencies than stablecoins across all use cases, particularly when accepting payment in the form of crypto and enabling customers to pay with crypto. Even though this question was asked in the context of assuming all these technologies were available in their respective countries, it's worth noting that respondents are likely more familiar with cryptocurrencies than CBDCs and stablecoins, and already have experience using them. We did see that those who have cryptocurrency experience are more likely to use all three technologies than those without cryptocurrency experience. Benefits. Finance decision makers, particularly those at financial institutions, expect CBDCs and stablecoins to enhance data management capabilities, i.e., visibility, traceability, and control. Additional cited benefits include the ability to create new revenue opportunities and improve operational efficiency. For stablecoins specifically, respondents see equal value in the technology's ability to give their company a competitive edge. Thanks to accelerated transaction times, CBDCs also afford many benefits to citizens and end users when it comes to disbursement of funds or aid and much more efficient payments in remote parts of the world. They offer the ability to extend even the most basic financial services to historically underserved populations by way of mobile phones and digital wallets. That's because lower income users or those that have been underserved by traditional banking will only need an internet connection, e.g., through their mobile phone, to gain access to more affordable financial services, and new participants can be brought into the market, including new starter banks, fintechs, and the unbanked. All right, so then we have a little box here. It says finance leaders' own words about their confidence in whether CBDCs can meet their business needs. And it has a thumbs up. Reasons why they are highly confident. Central bank digital currencies are being adopted by many businesses and widely used across the world. That was from a financial institution in the United Kingdom that said that. From a financial institution in the US, they said central bank digital currencies can ease my business needs because it makes it easier to carry out cross-border consumer-to-consumer payments and transactions within businesses. And a financial institution in Argentina said, as central bank digital currencies have lower transaction costs than physical currency, they are more cost efficient than physical cash, so these currencies meet our business needs. Then as to a thumbs down, reasons why they are less confident. Here was an enterprise in the United States that said, once major Americans and European banking institutions adopt central bank digital currencies, then I will be more confident in them. And a financial institution in the US said they were concerned about government control. Okay, so we made it to page 21, and I'm going to stop here because it's been quite long, but we made good progress. There's some really good information in here. I hope you're enjoying this. I'm really learning a lot by reading this, so I'm actually really glad that I'm doing this. It's forcing me to do it. I actually read it once on my own, but I'm getting a lot more out of it just going slowly and reading it out loud. So thank you for letting me do that, and hopefully you're getting more out of it too, and more will stay with us, I think, over time. So we will continue tomorrow with part 3. Thank you for listening. If you like this, please hit the like button and please share, and remember to subscribe to the channel. And I will talk with you tomorrow. That's all for today. Until next time, live the good life and be wealthy and smart.